Welcome everyone to this webinar about exit planning presented by Moorcrofts and Nunn Hayward. So first of all, introductions. My name is Teri Hunter and I'm a partner and head of the corporate team at Moorcrofts LLP. And Steve here is a partner and head of the tax team at Nunn Hayward. So the webinar today is to talk to you about the different types of exits you might be interested in. In part one, we're going to look briefly at the sale process, in particular what you can expect from the legal and financial due diligence process, the types of things that the buyer will want to know about your company, and also the things that you can look at now to help prepare for sale. In part two, I'm going to discuss some of the usual types of exit structure that you could expect to see. And in parts 3 and 4, Steve is going to discuss some of the alternative sales structures, namely the employee ownership trust and the employee benefit trust, both of which offer tax-efficient paths for exit planning. We also hope to have time to answer questions. So if you do have any, please type them in the text box as we go along, and we'll do our best to answer your queries at the end. So we start off with part 1, which is the legal and financial due diligence. So by way of background, let's briefly look at the process of a sale. So once you've entered into discussions with a buyer, the first document that you'll see will be a heads of terms or a letter of intent. And this is a non-binding statement setting out the main terms and principles of the deal. And once this is signed, we then move immediately to due diligence. So due diligence is where the buyer will ask questions about the target entity and will seek to get all of the legal and financial information about what they're buying and generally satisfy themselves that they're paying the right price. So this process can take several weeks and it will require you to get together as many documents in support of your answers, as well as answering specific inquiries that the buyers or their lawyers might have. So once the buyer thinks they've got a fair idea of how the company is run and the overall picture, they'll put together a share purchase agreement or SPA. Now, the SPA will cover off many different matters, including the consideration that you receive, how it will be paid, how you deal with surplus cash in the business, restricted covenants, confidentiality, and, of course, warranties. So for the purposes of this section, it's the warranties that we're concerned with today. So warranties are an absolute set of statements about the company, and some examples might be the company is not engaged in any litigation, the company has no change of control clauses in any of its contracts, and there are no employee disputes. So these are just a few specific examples, but there's likely to be 30 or 40 pages or even more of warranties in a share purchase agreement. So if the warranties in that agreement are not true, the buyer will have a cause of action against the sellers personally and can sue for breach of those warranties. However, no company is in absolute apple pie order, and no seller owns a company that can give a completely clean set of warranties. So to deal with this, we engage in a procedure called disclosure. So if a warranty is untrue, rather than amending each individual warranty, we disclose against it in a separate document called a disclosure letter. And to the extent we fully and fairly disclose all the relevant circumstances and tell the buyer everything there is to know about that, then there can be no claim against the sellers for breach of that warranty. So the due diligence and the disclosure processes, although not exactly the same, do go hand in hand, and you need to engage with both the DD and the disclosure, DD being the buyer's opportunity to ask questions, and disclosure being the seller's opportunity to tell the buyer everything we want them to know. Now, it's not a question of presenting the best view of the company. At this stage, we want to disclose all the wrinkles, get all the skeletons out of the closet, so after sale, the sellers can sleep easy knowing that there'll be no warranty claims down the road. So let's look at some of the types of questions that you're going to be asked during the due diligence process when selling the company. So first of all, does the company have formal contracts in place with its key customers and suppliers? If not, is this something that we can look at and regulate now? Do you use standard terms and conditions of sale, or do you contract on the terms of your suppliers and customers? If you use standard terms, are they always used? Are there any variations? And if so, do you keep track of the variations? Can they easily be identified and tracked throughout the contracts that you have? In particular, buyers are going to be looking for onerous clauses, such as liability clauses, guarantee and indemnity clauses. In addition, they'll want to know, is the company signed up to provisions to say that it will meet certain service levels, or that the company will put things right if things go wrong for a customer? If so, is there any limit to that sort of liability? Also, they'll want to know if there's any change of control clauses, which is particularly pertinent on a sale. If the company is sold, does it have to notify any third party, or even do the contracting parties have the right to terminate on a change of control? Finally, do the contracts contain any other external consents or approvals that are needed for a sale? Then we also might want to look at property, which is another major area to be looked at on due diligence. And you'll need to be able to show a clear line of title to any leasehold or freehold property that you have. Do you have all the relevant deeds to hand? Do any of the leases or licenses need to be renewed, or is a renewal coming up? Should we be looking to update that in advance of a sale? Has landlord's consent been obtained for any alterations that have taken place? And again, if not, can we deal with this now? Do we keep up-to-date service records? Can we put our hands on these if we need to? And does the company have all the necessary statutory reports and environmental permits for their use of the property? Again, if not, let's remedy this at an early stage. Next, let's consider the company's assets. In particular, are the assets held outside of the company? This is common, for example, where companies are set up after trading has begun. So properties or intellectual property may be in the name of principal shareholders rather than the company itself. If there are any such assets, can they easily be moved into the company? If we're not going to move them into the company, can they be included as part of a sale in a different way? Should any of the company's assets actually belong to the shareholders, a car perhaps? And can we also move those? And if so, can it be done easily? Also, we might want to consider what the tax consequences of the movement of any of these assets might be. Next, let's consider our employees. So we need to make sure that employee contracts are in order. Do we have written employment contracts for everybody? Are the contracts regularly reviewed? Are restricted covenants and other terms appropriate and proportionate to the level of responsibility of the staff? Is there a staff handbook in place? And if so, is it up to date and fit for purpose today? We also need to just have a check to make sure that employment contracts are legally compliant. Do they contain the statutory requirements like holiday, sickness, working time regs, etc.? And do the contracts sufficiently protect the company in respect of its confidential information? Finally, do you have a full and proper set of records relating to all of the employees of the company? And because of the problems of GDPR and this very confidential information that we would need to be disclosing at some stage about our employees, is the information in a form that can be easily redacted so that we can just share with the purchaser what we absolutely have to at the beginning, and then later let them have further information as we get closer to a sale, to the actual completion of a sale. Next, we may also need to consider intellectual property. Does the company only own any valuable intellectual property that needs to be considered? As well as proprietary software, consider more everyday matters such as branding, logos, designs. Has all the intellectual property been registered and properly protected to the extent that it can be? Whether or not we're using a third party's IP or whether we are licensing our own IP, are all the necessary licenses and assignments in place? Are there any open source issues that need to be considered? Do any of your third-party developers or content creators have any rights over the IP? And do any of your employees have any rights over the IP? So do your employment contracts sufficiently transfer any IP that they create during their employment? Next, let's consider the share structures and share rights. So are the shares in the company held in a tax-efficient manner? In particular, should we consider any pre-sale transfers between spouses to use up allowances? We also want to consider the articles of association of the company, and this is a document the buyer will want to consider carefully. In particular, do they contain any provisions on what is to happen on a sale event And if so, is this still correct? Do you have different share classes that need to be considered? And are they treated differently in terms of the proceeds of sale? If so, is this properly documented in the articles? Or again, does it need to be changed? Are there any preemption rights that we need to consider? So these are rights that allow somebody else to have a right of first refusal over a sale. That would usually be the other shareholders in the company, but could also be third parties. So again, we need to look at this now and disapply any relevant sections. Do the articles contain drag and tag rights? So drag rights allow the majority shareholders to force the sale of any smaller shareholders on the same terms as the majority. They're not clauses that we ever want to use on a sale process, and we'd hope that all shareholders would want to be on board with any sale. But it does give comfort to a buyer that you can deliver 100% of the share capital of the company on a sale. So it's important to have these clauses there. Tag rights are the matching rights for minority shareholders, and that allows them to tag onto any sale, so prevents majority shareholders from selling without getting an exit for everybody. Finally, is there a shareholders agreement? And if so, are there any consents required under the terms of the shareholders agreement in respect of a sale? And again, are there any provisions that govern the sale process itself? If so, these should be reviewed and make sure that they fit in with your current plans. Next, let's look at banking and security. So the buyer is obviously going to be interested in any banking or loan arrangements and charges that the company has, particularly if they are going to survive completion. So first of all, make sure the company has copies of all key banking documents. Do any of them contain any change of control clauses? And would any sale trigger the repayment of any existing loans? Finally, consider whether any consents would be required from the bank or any other lenders to any sale of the company. Now we're going to move on to the financial and tax due diligence questions that might arise, which Steve is going to take you through.
Thank you very much, Terry. Good afternoon, everyone. Thank you for taking us through the legalistic side of the due diligence process. Finance and tax, probably not on the top of everyone's list of subjects to listen to. So what I've tried to do here is identify some of the more practical areas that we come across when we're dealing with clients in either in buying or selling businesses, actually, although I couldn't resist a few techie ones slipping in. So the first point on the slide, you might think that's obvious, but actually, if you're not clear on the reason why you're selling and why you're selling now, it's very easy to give the perception of a rushed or a fire sale type sale. But that can affect significantly the value somebody's going to offer you for your business. All the other points on the slide all have in common that they're about preparing for the sale, and probably something that you would put in place and make sure you've got in place well before you even approach the market for a sale. They're all practical in a way, but they are finance related. So next slide, please. Picking up the top point, you, of course, being the accountant in the room, audited accounts. Now, the levels for a formal audit are actually very high these days, and a lot of businesses, if they can avoid it, will not go to the hassle or expense of paying for annual audited accounts. You might need them for other reasons, such as outside investors, for example, or banks, finance insisting on them. But actually, the other reason you might consider whether you might prepare one or even two sets before a sale is that they give a lot of confidence to the buyer as to the numbers you're relying on, because they've gone through this extra audited process. They also reduce the amount of work and time that has to be spent at the time of any due diligence, because of they're actually doing a lot of that work up front. You need to. A due diligence process is primarily about understanding the risk for the buyer's perspective that they're taking on. If you haven't, you need to make sure that you've done a review as to how you're managing it, how you've identified them, and how you're addressing anything that comes up. the last sort of 3 or so bullet points, they're all about actually giving confidence in the numbers. So you've got the history of preparing management accounts and cash flows, the history of what happened and how accurate they were or weren't. And then, of course, that then leads into projections for the future growth. Hopefully that will enhance the value and the confidence that the buyer can have in the value that you're going to get for the deal. So next slide, please. Turning now to the tax, again, I'm not going to go into every last detail on these points, but they're there to raise what I come across in practice when I'm doing this. You'd be surprised at how many businesses fail to get the basics right. Their corporate VAT, pay-as-you-earn, construction industry scheme returns, and related payments to the revenue. If you present a history of late payments, you present a history of not paying attention to how your business runs on the finance side, and that can affect the value you get. The second point is actually one that I will spend a couple of minutes on because it comes up regularly, but it's not well understood, especially by people selling their businesses, and unfortunately by some advisors too. Back in 2003, there was some anti-avoidance legislation put in place, effectively to try and avoid shares being given to various people working in the city as a disguised remuneration that didn't attract national insurance. What's happened is, sledgehammer to crack a nut, the legislation applies to every transaction that happens in a company's share capital where the recipient of the shares is some form of director, officer, or employee. And that triggers a reporting requirement, which can be sorted relatively easily. Although there may be no tax, there will be penalties, etc., to address. But perhaps more importantly, what it does is trigger a tax liability on the sale proceeds for these shareholders that got their shares as employees under income tax rules. So they're going to have to probably pay some income tax on some of their share proceeds where they were probably expecting a 10% rate. If those people are key employees for the future, driving your business and the value, that can be pretty demotivating just at the time when you need them to be motivated to support your business. Self-employed workers and subcontractors, that's all about documenting the status of who you're working with and making sure you're not going to get caught out for past pay-as-you-earn liabilities of employees or are currently operating the correct status determination statements where you engage with limited company subcontractors. Next slide, please. On the VAT front, the biggest issue that we're coming across now is actually with regard to leaving the EU. Many businesses have just assumed that there wasn't a practical VAT problem in dealing with the EU, and because it's an international purchase or sale, there won't be one going forward. You do need to examine the type of business and type of transactions that you're having with EU companies and businesses, and document that you've done that review and corrected anything you've done wrong, because there may be some VAT issues, whether it's in this country or indeed the need to register in others. Research and development is an area where you can't fail to have seen in the press the revenue's view on the fact that the market for claiming research and development in the revenues views was a wild west of tax claims. They don't view them as, many of them, as being properly or legally supportable. And we've now got an environment where 2 years ago, it was very rare for us to get an inquiry into an R&D claim when you sent in full documentation. It's flipped pretty much the other way around. It's very rare not to get a detailed inquiry. Two issues there. Currently, a lot of time is wasted because the revenue have engaged 100 or so new staff in the R&D unit, but unfortunately haven't yet trained them all properly. So there's a lot of toing and froing, effectively us training revenue staff in how it works. The more important point is that if an inquiry is opened now and you haven't made full disclosure in the past, your acquirer will be looking to say, well, there's a risk that when we get an inquiry now, because there's a high probability of it, that they will be able to discover and open up past claims and challenge them. And therefore, because there's usually large numbers involved, you'll end up with a lot of tax issues affecting the value of the deal, retentions perhaps for 6 years. EMI share schemes are another area where, particularly if you've set up companies a while ago and due to genuine cash flow needs, obviously you had to choose as to where you spent the company's reserves. Unfortunately, this is an area where it was people have taken a shortcut. They've either gone online, used a template or something else online that's set up to save cash flow at that time. But unfortunately, that can come back now, because if you've failed to get proper valuations, if you've not notified the revenue on time, if you've not done annual returns, there's quite a high chance that you've triggered a disqualifying event on those share options. And what that means is that instead of your employees getting a nice 10% capital gains tax liability on their gains, they're going to be taxed as if you just paid them a bonus, tax and national insurance. Worse, the company will have its 13.8% national insurance to pay. I'm going to move on to the next slide and pass back to Teri now, who's going to cover the more general ways you would sell a business.
So, yes, Nick, thanks, Steve. Next, we're going to look at the types of structures that we might want to consider. So first and most straightforward is a sale to a third party. So the target company is sold 100% to a purchasing entity, and the sellers, the shareholders of the target, will receive in return some consideration for that sale. So that consideration can be made up of different elements, including cash, shares in the buyers itself, loan notes, which is a loan instrument from the buying company. So in effect, the seller lends money to the buyer to fund part of the purchase, or some sort of deferred consideration. So deferred consideration can take two forms. Either it can be a straight deferred consideration, i.e. the buyer pays in installments, or it can be structured as an earn-out. So an earn-out is a mechanism by which the company has to hit certain targets over the course of a period of time after completion. And if it hits those targets, then a further pot of consideration is released to the sellers. Earn-out targets can take any form, but commonly are EBITDA, income, or profit targets. It's also worth mentioning that this type of sales structure, the buyer may actually be a company that is backed financially by either a larger group of companies or a bank, or by private equity or VC funders, and therefore that there are potentially going to be other stakeholders involved in the negotiation and sale and due diligence process. So on the next slide, we'll look at some of the features of a sale to a third party. So as I've said, most straightforward way of selling the company. It's likely that all the shareholders in the company will get the exit at the same time. There will be a full due diligence process, and all the sellers will bear some responsibility for warranties, usually in the proportion to which they own their shares. More and more deals we're finding do include an earn-out element, and with the earn-out, there's a possibility of not meeting earn-out targets or having wrangles with the buyer at a later stage about whether targets have been met. Also, depending on how they're structured, the sellers might need to pay tax on the earn-out element up front before they actually receive that cash. Earn-outs can last typically anything from 1 to 5 years, so they're not a walkaway deal. If there is an earn-out, the sellers will need to play nicely with the buyer over that earn-out period, but at the same time will have lost control of the company and its ability to drive profits or meet those earn-out targets. So we normally look to put some protections into the share purchase agreement to deal with a period of earn-out and to stop unnecessary charges creeping in through the target, or the buyer changing the nature of the business, or doing other things that would prevent the sellers from meeting those earn-out targets. However, buyer is going to resist constraints after completion, which means that they're not able to control the company and do with it what they wish after completion. So we're going to want to keep an earn-out period as short as possible. Finally, it might also be agreed that some of the consideration is paid by way of shares in the buyer, and this gives sellers a second bite of the cherry on another exit of perhaps an enlarged group. So on to the second structure that we want to consider, which is the management buyout, or MBO. So this is slightly more complex in terms of how we set it up. And the way it works is that a new co is formed, which is owned by the management team. New co is primarily a purchase vehicle, so it doesn't have any prior trading and it won't have any cash. So cash to fund the purchase can be brought in a number of different ways. So either bank funding with security being taken over the target company, or the management team might be able to access private equity or VC funding to provide backing for them as a management team. Or there's a possibility of surplus cash in the target, either being dividended up to NewCo or being loaned to NewCo to part fund that purchase price. So the sellers here, or at least the principal shareholders, will get the consideration being cash and probably loan notes, as it's unlikely that NewCo will be able to raise the full amount of cash, although not impossible. So looking at some of those features of the management buyout, generally the case that the principal shareholders at least will get the exit in this structure. It might be that management already owns some shares, so they will be rolling over into the NewCo. The funding can be complex and will require either the equity funding, VC or the private equity, or some bank debt funding, which the business then will have to service. So this creates some pressure on the management team, and they may also be asked, probably will be asked, to stand behind personal guarantees. So despite the fact that the management team will know the business well, external funders will still require a full due diligence process. Note here that the management team will be sitting on both sides of the transaction. So the sellers will be relying on the management team to help compile answers for the due diligence process, and also to help disclose against the warranties. But the management team are also shareholders in the buyer and part of the buy-side team. So it's a bit of an odd anomaly, and conflicts do need to be carefully managed throughout that process. A management buyout is almost certainly going to include deferred consideration or loan notes, as I've said, and it might be a number of years before sellers get their money completely out of target. Now, the sellers could retain some control here, and there could be some clawbacks if payments are not made on time, particularly if we do structure this by way of a loan note, and if that's used instead of just deferred consideration, which is an instalment. We can draft specific rights into loan note instruments and put in restrictions on what the management team can do with the company during that payment period. So, for example, we could stipulate that the management team are not able to pay themselves any dividends or increase their salaries until all the loan notes have been fully repaid. There's also the opportunity to add, and would normally expect to add, some interest to those loan notes as well. So you'll get some interest on the money that's left behind. The sellers won't have management control of the company anymore. The management team will have that, as you'll have sold your interest. And it's possible that the management team mess up and you don't get all of your deferred consideration. Personal guarantees from the management team in these circumstances can help focus their minds and attention and keep them working hard to make sure that they make a success of things going forward. The next structure that I want to look at is a partial MBO. And here we still form a new co with the management team as shareholders, but the sellers also might take a sizable chunk of new co themselves and continue to work in the business and help the management team and the business further, then look to sell new co and target as a group further down the road. So it's an exit in two halves, if you like, for the sellers. So looking at the main features of this, the principal shareholders get their partial exit, so some cash and shares. It's still likely that there'll be some cash and some loan notes, but it does mean they get some cash now. They'll retain some control in how the company moves forward and can spend some time training the management team to run the business without them as the principal sellers and look for a further exit down the road. Funding again will be by bank or private equity or the target company, Almost certainly will want personal guarantees from the management team, and in this case, probably the principal shareholders will need to give personal guarantees as well. More likely here that we'll have a slightly more scaled back DD process, as you'll be selling the company to yourself and to the management team. So you already know about the business and what you're buying, but this will still need to be enough to satisfy the bank or other funders. It's still likely to include deferred consideration, and again, could be a number of years before the principals do get all of their money out, but can retain some vetoes because you're only divesting part of your interest. We'd probably need to get a tax clearance on this sort of structure because the principal shareholders are not completely exiting, and that clearance may be a little bit challenging, and there will need to be some commercial reasons for the arrangements and to doing it this way. Next, I'm going to look at a single principal exit, and this is another variation on the NewCo theme. So here, one seller may be cashing out completely, and you'll see in the diagram there that seller one becomes a shareholder in NewCo alongside the management team, whereas seller two gets cash and or loan notes and a walkaway deal. So the main features here of this type of exit is that one or more, it doesn't have to just be one, principal gets to walk away. Still will require funding from bank or probably bank or the company itself in these circumstances. There's less pressure on the management team because one or more of the principal shareholders will still be there to take the strain. There'll be a scaled back DD process, again, enough to satisfy the bank, and we'll probably have some sort of deferred consideration. The remaining principal shareholder will retain control and can try for a bigger exit in due course, so there may be some upside for them. And for the leaving shareholder, a walkaway exit without much in the way of warranties is beneficial to them, but they are leaving others behind to work for a second exit, and that is usually factored into the price. So we would expect in these circumstances that if a principal is getting an earlier exit than other principals, they'll get a lower price overall. Still probably need tax clearance, but it's going to be more straightforward here. It's probably an easier situation for HMRC to accept that one or two principal shareholders are retiring or leaving to do other things, and that other shareholders are staying and continuing to run the business. So then that brings us to the part 3 and part 4 of our presentation, which is talking about employee ownership trusts and employee benefit trusts, and these are the final structures that we're going to look at today. Both of these situations represent a full or partial sale to trusts, which are vehicles which will own the shares in the business going forward. And I'm going to hand you back to Steve now, who's going to talk you through these structures.
Thank you very much, Terry, for taking us through what I will assure you are the normal options for selling a business. I thought I'd just quickly set the scene. So we're in a climate of political change, as well as all the financial stress and strain there. So how can you capture, if you like, the value you've built up in your business today if you haven't got that third party purchaser lined up yet? How can you basically look at today's tax reliefs and the certainty you get with using today's rates and reliefs to realise that value? Well, the two options I'm going to look at are fairly recent additions to the arsenal of planning options that advisors have, and I'm going to cover at a very high level. You'll be pleased to hear what's involved with them. In the right circumstances, either of these could be a viable alternative to the exit process. So before I delve into the detail, on this diagram, on the left-hand side, you've got the sellers and target. That's basically you and your company. And what happens, as Terry mentioned, is you're actually selling the target to a special form of trust, an employee ownership trust. And this trust will, over time, pay you, the seller, out your proceeds, and you'll see, I'll come on to this in a minute, those proceeds are actually free of capital gains tax, so 0% tax. So the employees and the directors remain involved with the business if they want. There are some restrictions on the ratios of those, but you could view it, I suppose, as the John Lewis model, in that employees will receive input and some reward there. And so next slide, please. So what is it? Well, at its simplest form, it's a trust, but it's a special sort of trust that's been introduced by legislation in 2014. So since it was set up just under 10 years ago, as best we can ascertain, there's been about 1,400 of these EOTs set up. To start with, that was a very slow process, and typically it was just larger businesses that went this route. But over the last few years, as the advisors have got familiar with the legislation, etc., and how they can be used, a lot more owner-managed businesses are looking at this route as a viable exit option for them, and for the sustainability of their businesses going forward for the employees. So instead of having a choice of MBO, traditional sale, or actually just winding up, this could actually mean you can get some value, whereas you might not have been able to under the more traditional routes. Next slide, please. So who's going to benefit? Well, the business benefits, because unlike a pure sale to a third party where somebody is likely to come in and wreak havoc on the culture you've built up, you are still involved, and your employees are there themselves as involved, so they can build and grow on the culture you've built. And some recent studies of EOTs compared to other companies in their various spheres that haven't done EOTs have showed an increased productivity for the business. The employees, likewise, are more committed and motivated. They feel more involved. As I say, John Lewis idea. They also haven't had to put any personal financial investment into this vehicle, but they can share in the success, and some of it is tax-free payments that they get. So again, they're feeling both motivated and rewarded. Importantly, you are still able to target key employees with share scheme rewards and extra bonuses, although a lot of these will be taxable. The business owners, well, the value they've built up and the leadership and the succession plans, they can leave much more of a legacy than just selling out and feeling that they've abandoned the employees, many of whom they'll know and have got to know, well over the years. Plus, they get some very valuable tax reliefs. So next slide, which brings us nicely to the tax reliefs. Employees, as I mentioned, they can all be paid up to £3,600 a year free of tax. Now, there is going to be a bit of national insurance, but relatively speaking, it's quite a small charge. The way these bonuses have to be paid is based on types of tests that have no discretion. So it's things like length of service, remuneration, hours worked, etc. So in other words, you can't target a particular employee or group of employees over others. It's a common theme, and that's what helps with the overall employee motivation. The sellers, as I've touched on, they don't just get a 10% tax rate like with all other type of sales, they get this 0%. The catch is that more than 50% of the company has to pass into the employee ownership trust. So in other words, if you've got 4 founder shareholders, at least 3 of them will have to sell, even if one remains as a shareholder afterwards. Alternatively, founders can retain some smaller shareholdings, whether it's sentimental value or for financial needs, without having to sell it all. Another important thing that's becoming more of a matter is that if you want to sell at undervalue, so if you've already wealthy enough and you want to leave us legacy and leave some value in the business for your employees who've been loyal to you, technically that's a gift for inheritance tax and could trigger the need to survive 7 years and the inheritance tax issues. This type of trust gets an exemption, so that if you happen to go under that bus the day after setting up your employee ownership trust, there's no inheritance tax risk for anyone. The business, it gets the advantage of being able to make tax-free payments to employees each year, but it gets full corporate tax deduction on those payments. Next slide. So why set one up now? Well, the government, revenue, have published a consultation paper, and that consultation closed on the 25th of September this year. Parts of those paper talks were speaking about whether employee ownership trusts are sort of hitting the sweet spot, as it were, in terms of generating sufficient employee motivation, and therefore implied that the revenue might consider abolishing them completely. Other parts were looking at the tax efficiencies. You know, in the current climate, the 0% rate of capital gains tax for the sellers, you know, is extremely generous. Could that be capped, or could there be some sort of tiered tax rate, you know, because of the perception of benefiting the rich, you know, even though, you know, by rich I mean business owners generating lots of revenue and employment for the rest of the UK. Next slide, please. So you also have to think a little bit about your business as opposed to just the tax in the future. You definitely cannot use these as a mechanism to convert what would have been a 10 or 20% capital gains tax charge into a 0% charge, because there's a legacy period that the employee ownership trust has to hold the business for. Effectively, it's 2 years after the transfer in. Otherwise, you'll lose the CGT relief, or it will be clawed back and paid by somebody. There's also some restrictions for employee ownership trusts on the number of founders that can be connected with the business going forward, and that's set at 40%. The problem here is that if you have a relatively small number of employees and you have founders with spouses, children, aunts, uncles, nephews, nieces, the definition of their associates is quite wide. So you do have to be careful. You might have to sort of shelve a few associates in order for this to work, if an employee ownership trust is for you. I'm now going to move on to the employee benefit trust alternative. Now I'll cover off those of you in the room that are thinking, why on earth is Steve talking about an aggressive, abusive tax scheme here? I'm not, and you'll see why in a minute. But let's have a look at the structure and come back to that for later. So again, left-hand side is you and your company. Currently, what's done here is that in a special trust, which is for the benefit of employees and their families, is set up, but it in turn sets up a new limited company. And you'll see in a minute why that's important. But that limited company is what actually buys the target company. And a bit like some of the slides Teri was looking at before, it's a combination of retained reserves that are paid out up front to the sellers and possibly reserves over a period of time. So let's look at the next slide, please. So what is an EBT? As I say, it is just a discretionary trust, but it does have some special tax rules that give it some extra benefits to a normal discretionary trust. However, like all trust planning, those that are setting it up, in this case the founders, have to exclude themselves from benefit. But importantly, in addition to the employees of your company, your other family members can benefit from what's in this trust. As I said earlier, the limited company in that structure is what's going to own the shares. And that will also be the entity that will pay out relatively significant bonuses to the key employees that you're going to be identifying that will grow your business for a future sale. And that is key, because that's what gives this the commerciality that is needed. Broadly, any funds left after a sale, so once you've been paid out in full, once your key employees who've grown the business have been paid their bonuses under PAYE in full, any balance held in there effectively sits then in what would be a relatively common family investment company and trust structure for the benefit of your family. Next slide, please. So let's have a look at the tax reliefs. So as I've alluded to, the sellers under normal rules are going to get your 10% capital gains tax with the benefit of the business asset disposal relief. Used to be known as entrepreneurs relief, but it's now only on £1 million, and 20% up thereafter. As I say, the trading company that you currently got, it will have paid tax on its reserves, so it can use those reserves under the new structure to pay up and out to you any surplus that's not required for working capital. The future profitability can be paid out over up to a period of 8 years, because there's a special rule that it can effectively link the capital gains tax bill with the payment of the proceeds. So typically the paperwork is structured that if there's not been a sale, there will be a payment out to you in no more than 8 years. If the trading company is sold down the line, this is where the trust company comes into play, because that sale, the proceeds go into that trust company, and like any group company that's sold, it will qualify for what's known as a substantial shareholding exemption, which means there's no corporate tax on that sale, which is broadly would have been the difference between what it paid you for and what it's selling for. As I say, exit bonuses on that sale event will be triggered to your key employees, and they will be subject to PAYE tax and national insurance. Next slide, please. So having assumed that there was a sale, you've now got the balance of funds held in a trust company, which in turn is owned by your EBT. That trust company with the spare cash can invest it in the stock market, and if it generates dividends, you may not realise this, but companies don't pay tax on dividends because dividends have already had corporate tax paid by the companies that generate them. So effectively, what you could create is a gross roll-up fund of those profits over time. Importantly, when the trust was set up, it's set up for the benefit of the employees of your company, and that gets it into a special inheritance tax exemption, meaning that the normal tax charge that a normal discretionary trust would have to consider every 10 years of 6% of its value, it's exempted from. So you create an IHT-free vehicle. The trust basically operates like a normal family trust, assessing whether it pays out some income to beneficiaries, whether it makes loans, which would have to be interest-bearing loans. Now, because of all the fact that at all the time, anything coming out of the trust has paid tax, whether it's capital gains tax or pay-as-you-earn tax on bonuses, you are able to go to the revenue, set out what your plan is, and they will, in my experience, give you a formal advance clearance to the use of an EBT. Unfortunately, they just have this label that's got this historic issue. So looking at the next slide. So why set up one now? Well, the EBTs were also mentioned in this employee consultation. Perhaps they're perceived as a bit more abusive because of the past. So would the revenue abolish some of these reliefs I've been chatting about? What about the 10 and 20% rates that we're talking about now? There was an all-party parliamentary group that 2 years ago published a recommendation to the revenue, which said that capital gains tax rates should be aligned with income tax rates. Well, we've already got a maximum 45% rate. Who knows where that will go in future? What about setting up now a capital preservation exercise using known rates and allowances that also creates an inheritance tax-free intergenerational vehicle as your legacy to your family. Next slide, please. So I think it's important probably to finish on what you cannot use this EBT planning for. So in the past, various people in the tax industry, including very preeminent lawyers and barristers, thought that you could effectively use them for what's become known as disguised remuneration, and effectively pass money out to people that would have otherwise had them as salary as interest-free loans and tax-free loans. As I've already covered, this EBT goes nowhere near that. Payments are subject to pay-as-you-earn to employees or capital gains tax to you, and that's why you get the advance assurance upfront from HMRC. Although there's no specific rule about use for family companies, because you need to incentivise key employees, effectively, a normal family company with just family members can't use an EBT planning either. That having been said, if you want to undertake some planning with a family company, that's a whole selection of other alternatives that you can plan for, depending on whether you're passing to the next generation or a sale and exit. But as they say, that's for another day. So I think we are now at the time where we may have had some questions during the slide. I haven't seen them on my screen. So I'm going to pass over to the IT team to have a look at those. We'll do our best to answer a few now, time permitting, but we are going to send out an FAQ afterwards so that any that we haven't answered, we will give everybody the question and answers to make sure that everyone's got the full input on that. Thank you. Over to Teri and Marie.
Yeah, we've had a couple of questions in. So one of the questions is, if a warranty is breached, you said a seller could be sued. How much would that be for?
Okay. Yes, I'll take that one, Steve. That's good question. So the first thing to note is that we would write into the share purchase agreement some limitations with regard to warranty claims. So first of all, we would expect there to be a de minimis amount. So, we might say, for example, that anything under £10,000 we ignore completely because, it's just not worth getting into a dispute with somebody for that sort of money. There will also be an overall cap that's usually set at the level, either at the level of the overall consideration or something less than that, depending on the circumstances. And also, there's also a whole raft of other limitations that we would add, such as if the buyer does something to either cause or to increase the level of a claim, then a seller wouldn't be liable for that type of claim. So if the buyer gets through all of those limitations and still has a claim that they want to make against the sellers, then the next thing they have to demonstrate is that the value of the company as a whole has been diminished by that warranty breach. So if, for example, we had, say, an employment claim, say, that was worth £30,000, say we'd had to settle with an employee, we hadn't disclosed that, and the overall sale price of the company was something like, say, £5 million, that buyer would have to demonstrate that the company had been diminished in value by the £30,000 by that warranty breach. So it's quite a high hurdle for the buyer to get over to demonstrate that a £5 million company would have been diminished in value by a £30,000 claim. Obviously, if we're talking about a £250,000 claim or something bigger, then it's an easier argument. So the buyer has to make the case as to how the company has been reduced. So it's not just a pound for pound adjustment in terms of this is what the warranty breach has cost us, in terms of pounds and pence. It's actually demonstrating that the value of the company as a whole has been reduced as a result of that warranty breach. Hopefully that answers the question.
Thanks, Teri. Another question that we've been asked is, if you have a management team that wants to do an MBO, how do you go about securing funding?
I'll take this one just to balance it out, Teri. So Teri and I both are able to work with corporate finance advisors, and we both have contacts, some of which are common, that we would assess the type of business you're in, and a number of them have specialisms in particular industries. So we would be able to guide you to the most appropriate advisor in order to begin that process. I think that's probably all we've got time for. I'm just being waved at. I don't know if you've any other questions. As I say, we probably will tackle online and just send around an FAQ. What there will be in a few minutes is coming up a survey with just 5 very quick questions, just to get your take on what we've covered here today, and whether there's anything else that might be of interest in the future. And it just remains for me to say a big thank you to everyone that has attended today. I know we're all busy, and it is appreciated that so many of you took the time to listen in and hopefully hear something of use to the potential exits of your businesses. Thank you very much. Have a good afternoon.
Thank you, everyone.